Gold just dropped over $100 in a single week, and almost nobody noticed why. While everyone was watching the headlines about Iran, China's central bank was quietly doing something it has done for 18 straight months, buying more gold. So in this video, I want to explain what's actually happening with the price of gold right now, why it's happening, and what it means for your money, especially if you're getting close to retirement. Hi, my name is Jeff Reed. Hope you're doing well. Stick around for the finance. Stay for the part where I show you exactly what China thinks gold is really worth and why that number is very different from the one flashing on your screen right now. Okay, so let's start with where we actually are today. As of this week, gold is trading right around $4,550 to $4,100 an ounce. That sounds like a lot, and it is. Gold is still up more than 20% compared to a year ago. But here's the part that should catch your attention. Just a few months ago, gold touched an all-time high above $5,500 an ounce. So in a matter of weeks, it's pulled back over $500 from the top. That's not a small wobble, that's a real correction. Now, before I go further, let me define a couple of terms simply, because I don't want to lose anybody here. Gold's spot price is basically the price you'd pay right now, today, for 1 ounce of physical gold. No contracts, no waiting, just cash for metal. And when I talk about central banks, I mean the institutions like the Federal Reserve here in the US or the People's Bank of China over there that control a country's money supply and increasingly stockpile gold the same way a household might stockpile savings. Okay? Good. Let's keep going. So here's the mystery I want to unpack for you today. If gold just had its worst monthly drop in a while, losing about 5% in the last month alone, why are the world's central banks, China in particular, still buying it hand over fist? Doesn't that seem backwards? If you thought something was about to get cheaper, would you be racing to buy more of it? Probably not, unless you knew something the rest of the market didn't. Let's go through this in 3 reasons, because each one builds on the last. Reason 1, the official price of gold and China's real behavior don't match up. China's central bank just reported its reserves ticked up again in the most recent quarter, over 2,300 tons officially on the books, an all-time high for them. But in the first quarter of this year alone, various estimates put China's actual gold accumulation, official and unofficial combined, at over 240 tons. That's an enormous number. To put it in perspective, that's more gold in 3 months than most countries hold in their entire national reserve. And some analysts who track this closely, people who've spent decades in this market, argue China's true holdings, once you count what never gets reported to the World Gold Council, could be several times higher than the official figure. Right? So reason 1 raises the obvious next question. If China is buying this aggressively while the price wobbles, what do they know that the average investor watching the ticker doesn't? Reason 2, the plumbing of the gold market itself is shifting away from the West. For decades, the price of gold has essentially been set in 2 places, London and New York, through paper contracts, futures, and margin trading, most of it priced in dollars. That's the system the world has used since the early 1970s, when the US formally cut the dollar's last tie to gold. But this year, Hong Kong rolled out a set of reforms specifically designed to shift gold price discovery toward Asia. A central clearing system, a revived dollar-denominated futures market based in Asia rather than the West, and something called a Delivery Connect program that links directly into the Shanghai Gold Exchange. Think of it like this. For 50 years, the West has been the only casino in town, setting the odds on what gold is worth. Now, Asia is building its own casino next door, with its own rules, and it's starting to pull business away from the original one. And Asian trading sessions have actually been outperforming US sessions lately. That's not a coincidence. That's a power shift happening in slow motion. Which raises reason 3. Reason 3. The Federal Reserve is boxed in, and the bond market knows it. In June, under its new chair, the Fed held interest rates steady at 3.5 to 3.75%. But here's the twist. They didn't just hold rates, they quietly dropped their previous hints about future rate cuts. Inflation projections actually went up, not down, with headline inflation now expected near 3.6% for the year, still well above their 2% target. Meanwhile, the 10-year Treasury yield, basically the interest rate the US government has to pay to borrow money for a decade, is sitting close to 4.5%. Now, quick definition. A bond is basically an IOU. When you buy a Treasury bond, you're lending the government money, and the yield is the interest they pay you back for the privilege. When that yield stays stubbornly high while inflation also stays high, it tells you the market doesn't fully trust that inflation is under control. And historically, when trust in paper money and government debt gets shaky at the same time, that's exactly the environment where gold has done its best work. 1971, when the dollar cut loose from gold entirely, and 2008, when central banks flooded the system with new money to survive a financial crisis. Both times, gold eventually became the asset people ran to once they stopped trusting the paper. Now, before I keep going, let me take 30 seconds for something unrelated to the market, because I think it matters more than any chart I could show you. If you've got a retirement account and none of this, gold, bonds, the Fed, any of it, has ever been explained to you in plain English by an actual person, I put together a free retirement protection guide that breaks down how people are protecting what they've built during exactly this kind of environment. It's free. There's a link below this video, or you can just scan the QR code on your screen right now. No pressure, no sales pitch, just information. Anyway, back to it. So let's zoom out and connect these three reasons together, because individually they're interesting, but together they tell a bigger story. China is accumulating gold at a pace that dwarfs its official numbers. The trading infrastructure for pricing gold is physically relocating from London and New York toward Shanghai and Hong Kong. And the Fed, even under new leadership, is stuck between an inflation problem it can't fully solve and a bond market that's charging the government more to borrow because of it. Individually, any one of these might just be noise. Together, they start to look like the early stages of a much bigger transition in how the world decides what money is actually worth. Here's what the smart money, meaning large institutional and sovereign players, not retail traders like you and me, appears to be doing about it. They're not panic buying. They're not trying to time the bottom of this correction. They're accumulating steadily, methodically, month after month, treating every dip as a buying opportunity rather than a warning sign. That's a very different behavior pattern than what you see in retail investors, who tend to buy at the top out of excitement and sell at the bottom out of fear. Central banks have been doing the opposite for 18 consecutive months now. And look, I want to be really careful here, because I'm not going to sit here and tell you gold is guaranteed to hit some specific number by some specific date, and I'm not going to tell you the dollar is about to collapse next month. Anyone who tells you that with total certainty is selling you something, and usually it isn't accuracy. What I will tell you is this: the people who actually run the global financial system, the central bankers, the institutions building new trading infrastructure in Asia, the sovereign wealth funds, are positioning themselves for a world where gold plays a bigger role and the dollar's grip loosens just a little. The question isn't whether that's dramatic enough to make headlines. The question is whether you're paying attention to what they're doing with their own money instead of just what they're saying in press conferences. So let me tie this all together. Gold pulled back hard from its all-time high, and on the surface, that might look like the story is over, like the run is done. But underneath that pullback, China kept buying. Asia kept building new infrastructure to price gold on its own terms, and the Fed kept sending signals that it's more worried about inflation coming back than it's letting on. None of those are predictions. They're just facts laid side by side. And when you put them side by side, they tell you something that's genuinely worth paying attention to if a meaningful chunk of your future depends on paper assets, retirement accounts, or the value of the dollar holding steady over the next decade. If any of this resonated with you, especially if you've got $100,000 or more sitting in a retirement account and you've never really had someone walk you through how to diversify it against this kind of environment, we also offer a free one-on-one educational web conference where we go through this in more detail. No cost, no obligation, just a conversation. It's a good complement to the guide I mentioned earlier, worth 15 minutes of your time if this is even a little bit on your radar. Before you go, grab that free retirement protection guide. The link is below this video, or scan the QR code on screen right now. It walks you through in plain language how people are thinking about protecting what they've spent decades building in a world where the rules around money are quietly being rewritten. I hope you have a wonderful rest of your day, and I'll see you in the next one.